indication that the trend is about to end, because the Forex market thrives on those strong runs, those trending moves, and that's where you want to be. You want to be with the bank traders trading the Forex, the big trade breakout moves. So there's two ways you can do that. You can do it off a double bottom, or you can do it off a lot. You can do it on a kind of a higher low or a lower high. So here's our initial entry, which is probably an entry that would be a higher risk, because remember the trend previous to this has been strongly down. So you're stepping in front of probably some bank trading. So you've got to be a little bit careful about where you decide to get into the market, and you've got to know what your rule entry is. So do you take the double bottom, or do you take the higher low? The higher low is obviously going to have less risk, and it's probably going to be a higher probability setup. That's something that we need to kind of validate. But there's the second entry. So you've got entry number 1 here, so we'll mark that up on the chart. Entry number 1 is there, entry number 2 is here. So you could even position 2 contracts in, first one there, second one there, and this could potentially be your pullback. Now what we also have is we're long here, but we get the resistance bar set up, and once we get resistance set up, that's a potential sell area. But we can't sell the market unless we get the double top or double bottom, or sorry, the double top or a lower high. Now in this situation here, there's where the resistance level sets up. It's lower than this point here, so we would potentially be sellers here, and this would possibly take it, well, would take us out for a loss, because that's more than 10 points. So the idea is that we never really know where the market's going to go, so we're just taking. So we've got one contract long here, and once we see that set up, we move our contract to break even. And then we've got one contract short here, and that gets taken out. So there's basically our first losing trade, but we're still long, and we have an opportunity to add a second contract there. Now, because we've got a sell set up here, but the only thing is that has to be a double top, and there's no double top, so that doesn't count as a sell, so we remove that. Because the only time we're buying and selling is where we get a double top or that criteria for a lower high. So you can see here that once we're long in the trade, we may be taking the opposing setup, but the only time we would take the opposing setup, then that's okay, but you've just got to be making sure that that it sits with the rules that you've got. So as we see here, now every time we have a higher low, that's an opportunity to scale into a trade. So all you're doing is you're building your campaign or building your strategy going forward. And once we get our trade set up, because remember that the whole concept here is it's a campaign. It's really to get the most out of the move. So while we're watching the intraday market, we might be taking losses, the occasional loss here, we might actually be breaking even on some of them. We're actually watching the 610 and the 987, and they're just trending beautifully. So this initial entry that we got in at, that's just really kind of running the whole time. And every time we get a new level of support, we move our stop to just below the support level, and we're adding another contract. So really all we're doing is once we see this thing start going, we're just adding to the trend. We're just taking the trades, and the only time we would even look to sell against it is if we get that double top or higher low, and it will happen. But you can see there that most of these sell setups are not setting up with a double top. They're setting up with a higher high. So they would not be, there's only probably about 2 times in that whole run up there that we could potentially sell on the intraday smaller time frame. So the rest of the time it's just a massive run up. So probably from there you've got one selling opportunity, and there's a second possible sell opportunity there. Now don't forget, we're only selling if we've also got volume on our side. So that would be yes, a sell there, and there's a sell there as well. So we would have had two small losers, but have a look at the trade size. So, and remember too that we're adding to our position as we go. So we're just taking an opportunity to add positions. Eventually we're going to get knocked out of this trade. That's what's going to happen. But in all this time, we've actually got into the market based on two principles, one on price and the other on volume. So we're using price and volume. We're monitoring the higher time frames to make sure that yes, we would have been comfortable potentially taking the sell setups because we were coming up to major resistance on the higher time frame. So we would have said, look, you know, this may not continue, because we don't really, at this point here, we don't really know. Let me just get that first sell. Just here and also here, we don't really know where this market's going to go, do we? This market could definitely falter, and it's at 43, so it could have definitely just sold off pretty heavily. So we want to be able to take advantage of that. So when we get into a position, all we're doing is we're working out how we're going to add to our trades, and as I said before, by using the currency, the forex market, the smaller lot sizes, we can do it very, very comfortably and take advantage of excellent reward to risk using our money management principles, adding positions to the trade, and not really going in with everything we've got on the first entry, because that's not how you make money in the markets. You don't make money going in here with 5 contracts. That's not the way to go in. The way to go in is to position size into the trade and add or build to your campaign as you go along. So you can see here that this has run up. Now, the guiding concept here behind the campaign trading is going to the hourly and the 4-hourly chart. So we've got a 4-hourly chart here, and this is the Euro US dollar 4-hourly. Now, why do you think I've picked the 4-hourly and the 1-hourly chart? And I've just got those set to the currency. Anyone want to have a pitch at why I might be looking at the 4-hourly and the 1-hourly? Okay, so the reason why is because this is what the banks trade off. So the banks trade off these charts here. So if you see a trend develop on these charts, the banks are running the show here. That's where they trade. So basically, we want to, once the trend develops, because we know that from our charts, that once the trend develops on the hourly or the 4-hourly, we're in the trade, and we're just going to hold that until we get a potential turning point. And what we can see on here is we can see the bigger picture market structure. So as David's mentioned, we can see where potentially there could be a turning point, and we can plot out where the market structure is as far as from a forex perspective. But the advantage we've got, and this is really cool, the advantage we've got is that we know what's happening with volume. So we can see that there's volume divergence here on this. We know that where there's volume divergence here. Now that doesn't necessarily mean that this thing is going to not going to push higher. This could still continue to run higher, but it's at the moment this thing is off on a blow away, so it's really running hard. So what we want to do is we want to ride this for as long as we can, but we also want to be, you know, fairly reasonable about where we run our stops. So we don't want to give up too much profit. That's why we're using the 202 to work our entry and exit. So we're going to use that support. We use our trailing stop. Ideally, we want to just use support to keep us in the trade, but this thing is just absolutely running to the moon. So it's time to keep an eye on it and just watch for those higher bottoms that we're getting, higher lows, and it's just really moving nicely. So it's time for us to just keep an eye on, you know, the Euro US dollar. But you can see the concept. The concept is get in early on the intraday strategy. Use the cycle concept to work your buys and sells. Don't don't necessarily have to go in with the higher and more expensive futures contract, but we want to use that market to give us an insight into what's happening with volume. And then what we do is we add positions as we go. So all we're looking to do is we're looking for a win rate of between 30 to say 50%. And we are going, when we get nights like this where it's running, that's where we're going to make our money. You know, we might get a, 6-7 trades where it's just 10-point loser, but nights like this where you're in basically on this trade, you've probably taken a couple of losses on the way, but you've added one, you've potentially added 3, 4, 5, 6, 7, 8, 9, 10 positions to this run. So that's 10 micro lots, because remember, we want to basically keep it so we're just adding contracts as we go. And that's really the concept. We're just looking to, because on the 610 and the 987, I really fail to see where you can position in here, like unless you're using price action. But we want to use the dynamic support resistance to get ourselves in. So even if we go to the hourly chart, there's not really, there's no real telltale sign of how to position in there on an hourly or a 4 hourly. But on the 202, just beautifully adding positions as we go. So that's the whole concept of campaigning. We want to be able to go in. We're looking for a turning point as well, because remember, at some stage this trend's going to falter. So we've got to be watching price, because price will be, we already know the volume is we're starting to lose the momentum. We've got pretty much a double top there. We haven't got our resistance sell here yet. So once that sets up our sell resistance, we'll be looking to short this market, because that's our strategy. Our strategy is, right, well, once we get our sell, we'll short it, we'll work a 10-point stop. And yeah, look, we're going to occasionally get knocked out or lose a trade, but that's really the idea, because these markets will generally, remember the concept of the forex market, everything returns to the middle. So even if you find the market does run and it runs well, there'll be a point at which that elasticity will just pull back, and you'll get a nice run back to a good level of support or resistance. So that's what we need to keep watching for on our higher time frame as well, that there will be a point in the market on the hourly or the 4 hourly that this thing will just capitulate and drop right off from that trade. So be watching for those footprints in the market to see where the turning point potentially may occur. And if we go back to the 202, so it's an exciting way or a different way to look at the markets. It's really an opportunity for us to have a different approach to the way we trade than just trading crude or the DAX, or it's just another strategy that we can use, and we don't necessarily have to be watching the market all the time, but we can set our trade station up to alert us to when that double top, double bottom occurs, which I'm going to talk to Mike about. And once we get that alert, bang, we're up, we're managing our trade. Any other time, we're just waiting, because you'll see that if I bring up the 202, you've really got to have the trend develop. So we want to have a trend develop. We don't want to be taking the trade based on non-trending activity. So we really want to see a good size move, and you'll see that it doesn't, there's a potential turn there. Here's a turning point here. There's a double bottom with a higher low. So that's what you're looking for. There is a perfect there, double bottom, higher low. So you can see though that wouldn't have actually, that would have enabled us to add a position here, and wouldn't have got, we're not going to get that trend breakout. So we're really not going to get the big breakout trades